Well, hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. We just got done with a wonderful conversation on inventory. We talked a lot about cost of goods sold. We're going to continue that conversation into this chapter as well on inventory and cost of goods sold. And we'll also talk about how we value inventory, which is a little different. There's a couple different methods. We'll talk about those. We're going to talk about all of the costs associated with inventory. We'll talk about how to value that inventory. And the primary focus is going to be how we value inventory using the perpetual inventory system that we learned about in the previous chapter. We're going to talk about first in, first out method, last in, first out method, and the weighted average method to valuing inventory. So the first thing we should do is look at what makes up the total cost of inventory. There's a couple different items we need to take into consideration. We order goods for our business. We receive those goods. And we need to take into consideration how we're receiving those goods. Who's responsible for them while they're in transit? Is it at free on board destination? Is it free on board shipping point? Who's responsible for it? Is it the seller or the buyer? Are the goods considered to be on consignment? When you see the word on consignment means that you don't pay for those goods until they're sold. That's what it means, consignment. You may have heard of what a store called a consignment shop. Okay, that's real popular, consignment shops. A consignment shop, the way it works is someone will come in with some clothing that they want to sell, but the store owner doesn't pay them until the store owner sells their clothes. And then the store owner will pay the people that brought the clothing in. That's called on consignment. Basically means it sits on the store shelves until it's sold. And then at the time it sells, that's when the business pays for that inventory. On consignment. That's what on consignment means. And another thing we need to take into consideration are any goods that arrive to us either damaged or goods that become obsolete. The word obsolete means it's no longer relevant. Like, for example, I don't even know what number they're on these days. The iPhone 23 or whatever number they're on. I don't know. So many iterations of it. Let's say the latest version of the iPhone is iPhone 23. I have no idea. I'm guessing. 13. Okay, thank you. 13, 23, it's all the same. The years go by so fast. Okay, so iPhone 13, latest version. I don't know. I'm an Android person. So iPhone 13, latest version iPhone. And this iPhone 13, let's say your store's selling the iPhone 8. Well, that's clearly obsolete, right? It's no longer relevant. People don't want the 8, they want the 13. So you're selling the 8, that's obsolete. Obsolete means it's no longer relevant, no longer has a use. Obsolete. They stopped making it. Yeah, that's what obsolete means. Especially with electronics. Every 6 months, new phone. That's why I figured they're on 23 now. I guess it's 13. But that's what it means. They keep updating it. And the older ones, they become obsolete, no longer relevant. So these are the things we need to take into consideration as we're purchasing inventory, getting ready for sale. So many things to take into consideration. Also helps us determine what we're going to sell, right? I don't want to sell things that are obsolete because the buyers don't want that. They want the new stuff. We also need to, of course, take into consideration who's responsible for the goods while they're in transit. Is it the seller? Is it the buyer? Is it FOB shipping point? Buyer's responsible. FOB destination? Seller's responsible. These are the things we need to take into consideration. Are the goods on consignment? Who owns the goods? The word consignment, again, means that the seller of the goods is not responsible until they've been sold. That's what consignment means. The stuff is sitting in my shop, but it's not mine. I'm just the person that was consigned to. Okay? I'm the consignee. I'm the one selling the goods for the people that own it. The consignors, the people that own the goods. They give it to me, my shop, and then I sell it on their behalf. And then when it sells, I'll pay them. That's what a consignment means. And with consignment shops, there's no inventory. Because the store never owned the inventory to begin with. The store doesn't own the inventory. The consignors do. So there's no inventory when we talk about consignment. Don't worry, we're not going to talk about consignment past today. So sometimes goods become damaged or obsolete. Damaged means they're damaged. So they're broken. Okay? Broken. Send it back. Obsolete. Ain't nobody want to buy this stuff. It's old. Nobody wants the iPhone 8. The iPhone 13's out now.
Yeah, it's like, well, we see that a few times here and there.
Exactly.
It's like someone says, "Hey, I want to get this thing from Radio Shack." Like that does not exist anymore.
Radio
Sorry.
Shack. Exactly. Nobody wants obsolete products. They're gone. They're out of date. Obsolete. When it becomes obsolete, usually what happens is whoever's selling the obsolete stuff will try to heavily discount it. Heavily. Or we're talking, they might even take a loss on that stuff. I might try to sell it for less than what I bought it for if I can't move it, just to get it out of the store. Worst case scenario is I throw it out. I don't know. But obsolete, right? It's a loss. It's a loss. If I sell it for less than what I bought it for because it's obsolete, it's a loss. Or if it's damaged, it's a loss. I can't sell damaged stuff. Okay. So we talked about obsolete. We talked about who's responsible for when it's shipping. All of these are related to cost. The cost of carrying the inventory. So let's talk about the cost. How much is this inventory cost me? How much it's worth? I include all expenses it took for it to get to me. Okay. If let's say I'm Macy's, I bought some shirts from my vendor. Okay. My vendor got them from Bangladesh. I don't care about that though. I care about me, Macy's, buying it from the person who's selling it to me, the vendor. The vendor sells me the red shirts to me, Macy's, yeah. The vendor sends the stuff to me, to my store. Well, there's a couple costs associated here. The cost of shipping, the cost of me storing the box of red shirts in my warehouse, the insurance I had to pay on the transport of the red shirts, and import duties, also known as import tax. Those red shirts came from Bangladesh. Okay. My vendor is an international distributor. According to laws in the United States, certain areas, the purchaser, needs to pay the import tax on certain products coming into the country. Okay, that's the law. Sorry, no way around that. So, the red shirts wasn't just the cost of the red shirts. It's the red shirts plus shipping, storage, insurance, import duties. So remember the example I gave, right? Macy's paid, I forget what it was, 50 cents for each red shirt. That's just the cost of the red shirt. Shipping was an extra 10 cents. Storage was an extra 5 cents. Insurance was another 5 cents. Import duties was 2 cents. You add all those cents together, now we're talking dollars and cents, right? The point is, it's not just the original cost of the inventory. It's the inventory plus shipping, storage, insurance, import duties. All of these together equal the total cost of the inventory. Make sense? Minus any discounts, of course. Okay. In business, anytime you're selling something, we need to keep track of what we're selling. Yeah. And this goes back to what we were talking about in the last chapter. The perpetual inventory system and the perpetual inventory system. In an offline discussion, we talked about the need to audit to make sure it's correct. Okay. So I need to control my inventory. Reasons we need to control inventory for a couple of different reasons. Number one, make sure it doesn't get stolen. Number two, make sure that it's safe, it's secure. Number three, there's a cost associated with everything, and I need to track those costs. Okay? These are reasons why I do these. So we do this thing called internal controls. Internal controls is where we control the flow of our inventory. All right? We do that by using security tags, by making sure the inventory is on a planogram. It's in specific places around the store. Okay? Everything has a place. I got stuff secure in a locker in the back storage room. I go through that. That's inventory control. It's a control process. Yeah. Most companies, I wish it was all, we take physical count of our inventory in our store at least once a year. We'll shut the store down early that one night, call in a bunch of employees. They give us a sheet of paper with all the items in this area, with the current inventory, and then on the second column it's blank, and I go and I physically count the items on the shelf, and I match it with what's on the sheet. If it's different, I write in the actual number, okay, to adjust it. That is called an audit of your inventory. Taking a physical count of the inventory. I do that once a year. Some companies do it twice a year. Some companies do it 4 times a year. Some companies don't do it at all. The point is we're controlling our inventory through that process. And if it doesn't match for whatever reason, we make an adjustment. It's inventory control and taking physical counts. Regardless whether you're using perpetual or periodic inventory systems, we still need to make a physical count to make sure what we have on our shelf is what we have in our system, and that's how we know what we have available for sale. That's how it works. That's how it works. Now, here we go. How do we value our inventory? Well, there's 4 methods that you can use. Now, here, according to the IRS, and I'm not making this stuff up, okay? Let's say you have a retail business. Let's say, I don't know, your Petco, for example. And so your Petco, you as a company have selected one of these 4 when the company was first formed. Okay? You can't be changing back and forth. No. You can't do that. You got to select one and stick with it. Shanae, you good? All right, cool. Just making sure. Just making sure you're all right. So you select one of the 4 and you stick with it for the whole life of the company. Here's how those 4 work. Okay? The first one is called specific identification. This one's rare. Very rare. It's in that 4% category. Specific identification means it has a unique identifying number. This is common for companies that sell unique products. Example, a car dealership. A car dealership uses specific identification. We call those VIN numbers, VIN, vehicle identification numbers. It is specific to that particular piece of inventory, that particular car. Each car has its own specific identification number or a VIN number. This could also be true for companies that sell unique products. They have this thing called a serial number. Yes, Esmeralda, luxury bags, luxury handbags, like Louis Vuitton or whatever other fancy ones you guys like. So Louis Vuitton has etched in the leather, yeah, on the bag on the inside, has the serial number for that bag. It's unique to that bag. Okay, only that bag has that number. I'm sorry, what was that? Was that another example? I'm sorry. It's unique to that bag. Yeah, yes, wonderful example, Esmeralda, definitely. Yeah, luxury products. They have this thing called a serial number on it. Like some people like watches. Yeah, the watch has a serial number carved on the back of it. Specific identification. That's what those kind of companies use. Another inventory cost method, valuation method, is called the first in, first out method. FIFO. First in, first out.
They do that in the food service.
Correct. Exactly right. Yes.
Yeah, I do the same thing in retail too. Old stuff go forward, new stuff goes to the back.
You got it, Michael. And that is very common in your specific retail business because the products are perishable. They expire at some point. Okay. For businesses that sell products that expire, they probably used the first in, first out method. The food industry, grocery store, which is related to the food industry. That's why I always reach in the bag. Yes. Yeah, exactly. Grocery store, stores that sell perishable products that expire. They use first in, first out method. 48% of all businesses use the first in, first out method. Okay. So the way it works is, let's say I'm a grocery store. Okay, I place the order with my supplier for apples. The apples come into the store. Those are the first apples that I sell. Otherwise, they'll sit on the shelf and expire. So they come in, and the first ones to be sold. First in, first out. Make sense? I'm going to track that cost. The first batch of apples I ordered is 5 cents an apple. So the cost is 5 cents. Cost going out, 5 cents. Second cost, 10 cents. I'm still using the first in, first out. We'll go through it. I'll show you a couple examples. But that's first in, first out. That's the basics of it. The third inventory costing method is called the last in, first out method. Last in, first out method. Stores that use the last in, first out method would be retailers that sell products that do not expire. An example of that would be Best Buy. They sell electronics. Electronics don't expire. There's no expiration date on that CD player. There's no expiration date on that computer. There's no expiration date on whatever. Wine, a great question. It depends. Wine would probably be first in, first out in most cases because wine actually does, well, depends on the type of wine. Wine gets worse with age if it's white. It gets better with age if it's red. It gets worse with age if it is a blend or if it is a rosé. So usually first in, first out for wine. It could be specific identification if it's the high-end wine. Depends. Good question. But last in, first out, those would be like electronic retailers or clothing retailers like Macy's, for example. They probably use last in, first out. Their products don't expire. So the vast majority of them don't anyway. So last in, first out. And then there's another one called weighted average. Weighted average takes all of the purchases that they made and they divide it to spread the cost evenly throughout the accounting period. That's called weighted average. About 20% of companies use that one. Not as common, but examples of ones that use weighted average. Let me think about that one for a second. Oh, there's probably a couple of like retailers that sell a combination of different products that use weighted average. Again, about 20% companies use it. Not as common. Here's the differences. Let's say we sell. What do I sell? Let's say I sell pairs of shoes. Okay. Let's say I'm a shoe retailer. Let's say I'm Eldo. I'm Eldo. Oh, I'm Eldo. Hey, how you doing? I'm Eldo. Okay, I'm Eldo. You like guys like Eldo, right? I'm Eldo. I sell shoes. Okay, I got a couple of Eldo stores. Let's say I'm Eldo and I'm opening a brand new store, and I'm doing it in the month of May. I don't know which kind of inventory cost system I want to use yet. So I'm going to try this out using this example. Now, I ordered first pair of shoes on May 1. I ordered a second pair of shoes May 3. Third pair of shoes May 6. I'm going to identify which inventory cost system I want to use by trying out all three different types. Figure out which one is best for my business, my shoe business. So, the first thing I do is I calculate the first in, first out method. Get an idea of what that looks like. So I bought 3 pairs of shoes. I sold the first pair. The first in, first out. I sold the pair of shoes for $100. Remember, it cost me $45 for that first pair. So I take the sales price, or sales, minus cost of goods sold. In the first in, first out method, That's $45. The first order I purchased was the first one I sold. First in, first out. I sold it for $100. Minus cost of goods sold $45. That means my gross profit is $55. Sales minus cost of goods sold equals gross profit. So under the first in, first out method, my gross profit is $55. My remaining inventory is $135. How did I get that? Well, I sold the first one pair, but I still have those other two pairs that I purchased. So 70 plus 65 is $135. That's my balance of my inventory on my balance sheet. Make sense? We're good so far, right? Kia,
So far.
Yes.
good so far. Michael, good so
Hanging
far.
in there. Hanging in
All
there.
right. Cool. All right. So first in, first out. We see the sales minus cost of goods sold. Cost of goods sold is the amount of the first purchase, first in, equals gross profit, 55. My remaining balance is 135 because I still have those second two purchases remaining. Okay, so that's first in, first out. So now I say, Aldo says, okay, now I know first in, first out. Let me take a look at the last in, first out method to see which one works best for me. I still sold $100 worth of stuff. Great. My cost of goods sold in last in, first out is $70. Obviously, that's different than first in, first out. Why? Cost of goods sold is the last one I got in. It's the first one I'm selling. So my cost of goods sold is $70. Makes sense? 100 minus $70 gives me gross profit 30. My remaining inventory is 110. $65 plus $45, 110. Good so far. Yeah? Makes sense, yeah? Okay. The third possible selection for my new store, Aldo, is called the weighted average method. Weighted average is where I average the cost. I made 3 purchases. May 145, May 365, May 670. I add all those up together, I get $180. I divide by 3 purchases. Total divided by number of purchases gives me an average $60. Total cost divided by the 3 purchases equals $60. So, using weighted average, I take my sales minus cost of goods sold, $60, because I only sold 1, divided by, sales minus $100 minus the cost of goods sold, $60, gets me gross profit 40. My remaining balance inventory is 120. How'd I get that? $60 each times 2 left. 120. Now, let me ask you this question. Which of these 3 methods would you use and why? What do you think? Which one would we use, Aldo? Which one should Aldo use? Which one you like? Come on, don't all answer at once.
I'll say first in, first out.
First in, first out? Why?
Because that's the way of making sure that your merchandise or product gets a chance to not only have its time to sit in and does what it does, but it's not sitting there too long too. Like if it's food, it could get spoiled, or if it's clothes, it could be going out of style. So that's why the first in method, we try to use that and get that out the way. And how we get that out the way is we can throw sales or any type of things to make it look attractable, to get them out so that way the new inventory and could come in. And yeah.
It's nice, Makia. You're very antiquated, very well done, very well said. Now,
Thank you.
the other thing I would say, Makia, because I like your logic. Don't get me wrong, great, wonderful. You explain it to me from the perspective of a manager, which I like. You did a very good job. Now, if I look at the income statement and I compare first in, first out to last in, first out weighted average, gross profit is the highest with first in, first out. We like profit around here. So I agree with you. I think first in, first out would be really awesome. Any other recommendations?
Yes, I would do last in, first out.
Last in, first out. Now, Miss Edwards, now why would we do this? Last in, first out.
I would do that. I would do that because those, I believe that those would be sold before they could go bad. They would not go bad, so they would probably sell out quicker than going out of style or not being useful. They would sell first before that happens. Not like the other one. So that's why I would do that. They would sell first.
Okay, that's good logic. I like that. Now, let's break this down a little bit more, Miss Edwards. So, last in, first out. I just got that order in. I'm selling that one first. Okay. Um, let's look at the income statement. Cost of goods sold $70 because it's the last one I got in. $100 minus 70. Gross profit 30. Now it's the lowest gross profit out of the three options, which that part I don't like so much because I like profit. But I have the lowest carrying cost on my inventory. So that's a good reason. Yeah, good logic. I like that. Anyone else?
Yeah, I was gonna say number two as well, last in, first out. Because usually the seasonal stuff won't sell as well later on. So if it's coming in, then that's the current season.
I like that too. That's nice. Yeah, very cool. Especially when we're talking about shoes, right? And then the last one, weighted average. It looks nice. It's kind of like a nice balance between the two, but at the same time, I don't know if that's right for me. So I like your logic. This is a good discussion. And these are the types of discussions businesses have when they first start up. Which method do I want to select and why? So one reason why I might select option one, first in, first out, is because I get the highest gross profit. Option two, if I select last in, first out, my gross profit's lower, but my carrying costs of inventory are lower. So it's a good discussion. Great discussion. There's the correct answer. There really is not a correct answer because every business will make that type of decision for themselves based off of their needs. And so that's why, I I just really like that discussion because there's so many different reasons. Yeah. If it were me, if it were my business, uh, it'd be tough. It'd be tough between the first in, first out or last in, first out. I'm selling shoes, so I don't have to worry about them expiring. Uh, I like the idea of the last in, first out because I get the lower carrying cost. But my investors wouldn't like that choice because it has a lower gross profit. Something to think about. So as we sell inventory, we need to know how much inventory we have available for sale. And yes, this is the same as the last chapter for this part. We take our beginning inventory plus any purchases equals our merchandise we have available for sale for that month, which comes from our ending inventory plus cost of goods sold. It's the same. Now, we use our perpetual inventory system, which means we continuously update it as we're selling through. The effects on the inventory is that the ending inventory changes based off of what's being sold and when. And we update our costs of goods sold as we're selling. It's what perpetual inventory system does for us. The physical flow doesn't always follow the cost flow, but it's usually pretty similar. Here's a nice example of our, which one is this one? First in, first out, I think. We update as we're selling through and as we're making purchases. August 1, we started with inventory, 10 units, $91 was our cost, $910 total cost. August 3rd, made more purchases at $106 a piece. I bought 15, that's $1,590. My total inventory was 25 at that time. We see the unit inventory, it's updating based off of my purchases, yeah? Started with 10, bought 15, now I'm at 25. August 14th, I sold 20 units at $130 a piece. Now I'm down to 5 units remaining. I purchased another 20 units at $115, up to 25 units. I purchased another 10 units, now I'm up to 35. Then I sold 23 at $150, down to 12. 12 is my ending balance. I sold a total of 43 units. I have 55 units at the end of the month in inventory. Or I'm sorry, units available for sale, 55. Goods available for sale, 5,990. We see the updates continuously. That's the idea of the perpetual inventory system. If we use the specific identification system, the VIN number, the unique identifying number, the serial number, we update it based off of the totals, yeah. 5,990, cost of goods sold, purchase plus purchases equals ending inventory. Using the first in, first out method under the perpetual inventory system, the oldest costs are captured as the cost of goods sold. Most recent cost is our ending inventory. That's first in, first out. And this is what it looks like under the first in, first out method. I started the month, $91 unit. I had 10. I made some purchases. 106, 1,590. That's my first purchase, first in. So therefore, it will be my cost of goods sold because it's the first out. Under the last in, first out method, the most recent cost is our cost of goods sold. And our oldest cost is our ending inventory because it's last in, first out. So here's our month again, beginning balance, plus our purchases. The last purchase I made was on August 28th for $1,190. that will be my cost of goods sold for the month because I'm using the last in, first out method. And then, of course, the average is the average. Costs of goods available for sale divided by the number of units on hand. That's how you get your average. Goods available for sale divided by the number of units on hand. Cool. Cool. Yeah, weighted average. Still continuing. Oh my goodness, this one is typing it out. Yes, that's how we got there. Now remember, the weighted average updates with the additional purchases because I'm adding more to my on hand. My on hand count updates with more purchases. Yes. And the last one, cost of goods sold available for August 13th sale is $2,622. That's my average. Ending inventory, average. Now, the reason. We talked about the reasons why companies select one of those three. Yeah, the average, the first in, first out, last in, first out, perishable items, types of items they sell, etc. The real reason? Tax reporting. Businesses have to pay taxes on what they have in inventory. Okay. So first in, first out method gives an approximate current cost. Last in, first out method, approximate current cost. Weighted average smooths everything out. The effect comes from the taxation. Because I'm going to have to pay taxes on my balance sheet. Yeah? On my inventory. So when I pay taxes on that, it's very dependent on what we have on our balance sheet. So based off of that type of information, if I'm focused on how much I'm going to have to pay in taxes, the last in, first out method is probably going to be one I would use to pay a little bit less in taxation. IRS requires that when you use the last in, first out method, it must be used for financial reporting as well. It has to be the same. And that's why earlier I had said when the company forms, it has to select one of those options. It has to stick with it. It can't be changing throughout the year. No, we can't report based off of convenience. We report based off of the law. And so when we form the company, we stick with either first in, first out, last in, first out, or weighted average. And we don't move between those throughout the year. No, it's not supposed to happen. There's one other one I need to tell you about, not used commonly. Sometimes, especially if it's publicly traded, the company will use what we call lower of cost or market. This is called the replacement cost. And the lower cost of market can be applied to individual items or categories of items or to the whole inventory. The lower cost of market essentially tells us how much it would cost to replace that inventory based off of the current market price. For that reason, it would be the only reason you would ever use the lower cost of market. And we do that based off of the totals. Don't worry too much about this. Now, it's important to understand the effects of inventory on your income statement, because sometimes there might be errors, and the errors result as a result from changes in your cost of goods sold or ending inventory amounts that ultimately will overstate or understate your ending inventory. It could be from shrinkage, it could be from errors in counting, the available inventory, etc. But errors happen, and so we need to identify those errors and then make corrections for them. And these are just the impacts of what could happen on your balance sheet and income statement based off of under or over reporting ending inventory. That's why we use inventory management systems. One ratio that is super useful for identifying how quickly we are selling through our inventory is called the inventory turnover ratio. We take the cost of goods sold and divide that by average inventory. To find average inventory, we take the beginning balance plus the ending balance divided by 2. And again, this tells us our inventory turnover ratio, how quickly we're selling our inventory. As a manager, that's really helpful because it tells me when I need to reorder. Another useful ratio is the day sales in inventory. How long is it sitting in my inventory for? Very helpful to know this. We take ending inventory divided by cost of goods sold times 365 days. How long is it sitting on your shelves? Right? Here's a nice comparison between Costco and Walmart. Inventory turnover, day sales inventory. Interesting. Very interesting. That, my friends, is the end of our discussion on inventories, valuation of inventories, cost of sales. Any comments, questions, or concerns that you may have at this time? Anything at all?
Yeah.
Yes, please.
So next week will be 7 and 8, and then when will the midterm be?
Also next week. So great question. Week 4, next week, chapters 7 and 8, and the midterm will also be due at the end of next week.
Okay.
Next week's a very busy week. The busiest week, in fact.
So the midterm will be, oh, I see it. Okay.
Yep, it's there. It's open and available. I would wait until you do 7 and 8, though. Yeah, it's there. You can even take a look at it if you want. Open it up, take a look. But when you hit submit, it submits, so don't do that. But I'll give you an example. You could find those questions, write, take notes, all that good stuff, whatever you like. It's open. Any other comments, questions, concerns? All good. Okay, so for
I have a question.
yes,
Sorry.
please. That's
So
okay.
for the quiz, I did do it late. I did it today.
Okay.
But are you deducting points or?
No, I won't deduct points.
Okay.
Just make sure it's all done. Anything that's past due, just make sure it's all done.
Okay. Thank you.
You're welcome. Good question.
Thank you so much, Dr. B.
You're so welcome, Tiffany. Appreciate you.
Appreciate you as well.
Thank you so much. So just as a quick reminder, Chapter 5 quiz, Chapter 6 homework, they're both due this Sunday night. So
Okay.
please make sure you take your Chapter 5 quiz, Chapter 6 homework, and make sure they're submitted by Sunday night. If you
Definitely will. And also too, I know now, I know when I did my discussion this week, I didn't have my references because I wasn't
Gotcha.
familiar with how to put that on there. But now that I saw how everyone else was doing it from here on out, I would definitely make sure that's included in my discussion notes.
Awesome. Thank you so much. Please do that. Yeah, and
Okay.
feel free to just
I
pop
have
it in.
a question.
Yep. Good question. I'm sorry, go ahead.
I have a question about that discussion.
fine.
I want
Yes.
to do it, but I didn't know how. And I cannot see any examples. So just
You can't-
answer that questions, or I have to answer to someone else?
Yes. So thank you for your question. So what you need to do is open up the discussion, and the requirements are right here. All responses must be in full paragraphs, include citations and references, and respond to 2 or more of your classmates with full paragraphs. So just like some of your classmates did here, they answered in full paragraphs. They answered, answer all 3 questions, full paragraphs, reference. And then they went to some of their classmates and they wrote full paragraph replies.
Because I cannot see any answers from my classmate.
Once you submit your work, you'll be able to see everybody answers because it's late. So
Okay.
once you submit your response, then you will be able to see everybody else's response and you could reply to the classmates that way.
Correct.
Okay, I see.
Yep.
Okay. Thank you so much.
Exactly right. Thank you so much.
Yes, Professor?
Yes.
Okay, so that's week 3, and let me write this down. For next weekend, it's week
Yes, ma'am. Yep.
week 3.
Yes,
And
ma'am. You got it. So in the classroom, go to module 2.
Yeah.
Week 3, and we
Yeah.
have chapter 5 quiz, chapter 6 homework, and they're both due Sunday night.
Right, week 3
Yes, ma'am.
and chapter, what is it?
Chapter 5 quiz, chapter 6 homework. Those are the 2 things due Sunday night.
Right, 5 quiz, 6 homework,
You got it.
and that's week 3.
Yes, ma'am.
Got it. Okay, I'm getting it all kind of mixed.
That's
Okay, yeah, here it is.
Awesome.
Thank you.
Thank you so much. Take care. Have a wonderful evening, everyone. Please stay safe. Wash your hands. Do the right things. I'll see you all again, the same channel, same time next week.
Thank you, Professor. Have